Hey everybody, hope we're doing well and welcome back to the LAGFX channel. Now, quite simply today, I just wanted to go into the charts, another learn to trade video, and quite simply just run you through how I, as an intraday trader, actually go about analysing the market and executing trades throughout the day as I'm looking at multiple different markets. I will typically start off the week by doing heavy top-down analysis on a few different pairs and decide which ones actually look the most valid for the week. So I'm basically trying to find pairs that are at a point in their price cycle phase that they are approaching a reversal point or delivering intraday structure that is much easier to trade. Any pairs that are very sideways, I'll typically stay away from. So the euro to the US dollar at the moment has been very, very sideways, although it can still be traded. It is a lot harder and delivers much less plentiful trading opportunities. But without getting sidetracked, I'm just here on the Great British Pound to the US dollar. Quite simply, just wanted to start by explaining the steps that I take in order to prepare myself for the day, for the week, to try and profit in the best possible ways from the market. So first things first, as I stated, top-down analysis that has to be done. If you do it correctly, you can typically just do that top down once a week, maybe even once a month, because when you're using those higher time frames like the weekly, the daily, when you create a bias, when you set up your parameters, it is going to take weeks, months, potentially multiple months to actually play out in that desired position. So after we've done the top down, we gain that bias and then we work down the time frames to get to those lower ones so we can actually be an intraday trader and find those opportunities that will actually play out throughout the day, so we're not having to wait and hold positions for weeks and weeks. So first things first, I will of course identify structure. So looking at this, quite clearly anybody who's a trader will know that this is bearish structure. So we're in a downtrend phase. We have a high set, a low set. The next high that comes up from our correctional wave is lower than the previous high, so that is a lower high. The next low has penetrated the previous low, so that is a lower low. Another lower high, another lower low. Now, upon analysing this, I've used the 3-box strategy as I always do. So I've identified the most recent impulsive wave. So that is our lower high all the way down to our lower low. And then within that impulsive wave, I've tried to find any areas that have unmitigated positions that are the most valid. So we could have arguably looked at each single one of these highs, created these swing highs, and tried to find a supply zone within them. But it's not as valid because we have this unmitigated position right at the top from the distribution Wyckoff schematic that we had in the previous wave of this trending market. So what I think is going to happen, as I've labeled here, is that these highs are just representing points of liquidity. A lot of people that are involved in sells will either trail or set their stop loss to these highs with the assumption that it marks an area of supply, an area of resistance. So there will be liquidity there. And considering the fact that we do have an unmitigated position all the way at the top, the smart money operators are just going to view these levels as liquidity rather than supply zones that they want to reverse price from. So that is the reason behind this supply zone being where it is. Of course, we take that high as our invalidation zone. So if price was to pass that, we know that this bearishness is invalidated. We'll have an S&D flip. And from there, we will start actually looking from a buying bias. And then low set, our final target, we can make the assumption as long as this level is held, that bearishness will continue, and as a result we will have another lower low set. So we can expect that when we get involved in a position, longer term price should slowly trade its way down to and past this level. So that is where arguably our final take profit would be. Of course, taking partials along the way, but we will get into that as we delve deeper. So I've labeled this up quite simply. I've used an 8-hour time frame here, and this is something I would typically do, and what I have done, I did at the start of the week. Now, of course, I don't have to keep refreshing this higher time frame analysis all the time, because for this move alone, so what we were waiting for with this correctional wave to trade back up, we have been waiting since the 20th of December, and we're currently just beneath it on the 11th of January. So we are looking at about 22 days there So I've not had to, or I wouldn't have had to update or refresh my analysis within those 22 days at all, unless we saw some sort of reversal in here that was relevant, but that wasn't the case. I've now highlighted areas in here. So once we saw this reversal through an accumulation, so a Wyckoff schematic, and when we do see that accumulation, we can make the assumption that price is now ready to reverse and put in that correctional wave. So once we see a displacement, so we have highs set in here, this move through displaces this. We have an S&D flip. We can then start looking for buys. We come down, mitigate demand zones, set a new high, and then continue trading upwards. So what we can do once we have signs after that displacement that bullishness is now coming for this correctional wave throughout our intraday trading, we then know that our bias is to be a bull, is to be a buyer, because we want price to trade up into here. So until price touches this region, we are going to be a buyer. We're going to find opportunities to enter this market on the long side. What I'll do now is I'll drop down the time frames and show you exactly how I would actually go about trading these areas intraday. But the point I was trying to make here is that you need to use that higher time frame bias as you move forward, because when you are doing your intraday trading, you need to understand which side of the market you want to be on and which parameters we have set, because if we do get involved on buy positions in here, we know that our final take profit quite simply needs to be at this supply zone, because that is where we expect from our analysis the price will trade up to. So anywhere we could have got in within this area, we could have rode that price all the way up to here. Now, if we were to just use those lower time frames and we were to get involved in the market down here, maybe our take profit would only be at the previous intermediary high. Now, what this means is that that trade, let's say, was a 2-to-1. Now, if we instantly bump our take profit all the way up to here, we can multiply that to 4, 6, 8-to-1, which is doubling, tripling, quadrupling our returns just because we've used a higher time frame bias. So the market is currently live, what you are viewing. So this is live as I'm recording the video. This is the way that structure is playing out. So as I've done, as you saw where I highlighted those intermediary buy positions or buying opportunities, we are just viewing this structure as bullish structure and doing the same thing we did when we were looking on those higher time frames at the bearish structure. So we're identifying those impulsive waves using our blue box, identifying the last unmitigated positions, waiting to see if price taps them. If so, we're then using lower time frames to find a Wyckoff schematic. In this case, we're looking for accumulations. We found that price reverses, puts in that next leg higher. We have that correctional wave, and then we have another impulsive wave. Again, identify that, look for the last unmitigated positions. If we can confluence that with a market inefficiency, even better. We've been able to do that here because there's inefficient price action throughout this region, no clear retracements to mitigate any positions between this area. It's just a clean impulse up. But then in here, this is much more efficient structure. Now, when I did this analysis, I thought this was the high set. This doesn't invalidate the analysis because this area is still an unmitigated position with a market inefficiency. So it is still a valid point of interest to be looking at. So all that I simply do, as you can see on the chart, I have an alert set here. I'm just going to wait for price to trade back down if it does do that. And then I'll be pinged. I will look for an accumulation and then I will get in on that position. So the point that I'm trying to get across is that you need to decide what kind of trader you want to be. If you want to be an intraday trader, all you do is you just keep working down the time frames. If you are much more focused on longer term holds, let's say you're still working a full-time job, you don't have much excess time, you will use something like the daily 4-hour, 1 hour potentially. Do your analysis there the same way you would on any time frame. Find your points of interest, set those alerts, and then just wait for price to approach those. The reason why higher time frame structure is more desirable is because once price approaches that point of interest, it could still take hours and days until we're delivered confirmation. So we are given much more time and a better opportunity to actually get in on that trade. So if you are busy, let's say you work 9 to 5 and your alert was pinged maybe halfway through, but you didn't actually see that until you got home. So you're actually 6 hours after that alert was pinged that you were actually getting to the markets. But because we're on a higher time frame, we may only have one candle created in that space. So what that means is by the time we get back and actually view the markets, we're still at a valid entry level. We can get in on that position and then hold it for potentially weeks. We don't really have to do much to manage that trade. We can just let it run and let the profits deliver. Of course, when we're on higher time frames though, there's less plentiful opportunities and we are having to wait days, weeks until those opportunities pan out. If on the other hand you are somebody who has much more time and you potentially trade full time, or you are still in education and you get half terms, summer holidays, whatever that may be, you can bump down to those lower time frames because you're going to be active on the market. So when something pings, you can be there straight away and you won't miss those opportunities. Now, the process on any time frame is the same. We identify structure, points of interest, and then find entry confirmation. All that we do that is different is when we do our top down, let's say we started on the week and then the daily, and then if you're somebody who doesn't have that much time, maybe you'd stop at the 4 hour. If you're somebody who does have time, you would keep bumping down with the bias that you gained from those higher time frames. You would just continue to analyze the lower time frames, find those opportunities and get in on those day in, day out. So as I stated, we can now go even lower. So this is the structure we're looking for. This is the point of interest I'm hoping to be fulfilled. Let's go down to a 5 minute now. And we can see that this in itself is structure that could have been traded. We could have done the same thing, identified an impulsive wave, and then identified those last sells before our buys as a point of interest, wait for price to approach, and then gone down to a lower time frame. So in this case, I'll go down to a 15 second. We can look inside of here and then straight away I'm seeing this, an accumulation. We have the manipulation of the lows, we displace and then start uptrending. So we're here, we have our Wyckoff. You can see that in here, if we actually figure this out, so this structure started yesterday at 5 minutes to 11 and basically played out within, 3 hours, just over 3 hours. So what that means is rather than us waiting 3 days or 3 weeks for something to play out, every couple hours we are being given trading opportunities that we can get involved with. So if we have the time to be at the markets, that means that every few hours we're being delivered something we can get involved with. On the flip side, if we don't have the time, of course, we can't expect that every couple hours when a trading opportunity comes to us, we are going to be there and are going to be able to capitalize, in which case I would recommend sticking to those higher time frames. Although there is a less plentiful trading opportunities, it just means that you aren't going to miss out on things, and it just adds less stress and worry to your life, because the last thing you need if you've got so many other responsibilities is trading taking up time and stress, energy, and putting on psychological stress. It's going to affect other aspects of your life. So just to round this video up now, the main point I want you to take away from this is that you need to decide what kind of trader you want to be. As an intraday trader, I will use the 1, 3, 5 minute time frame. I will look at structure and I will have those plentiful trading opportunities because I am here, I am present, and I can capitalize on all of them. What that means is that I just have to do further analysis. As you saw just in this video alone, I started on the 8 hour, determined that price longer term was in that bearish structure, identified my parameters. So we had that supply zone at the top, which we wanted price to trade up to, and then we had our final target at the bottom, which we wanted price to, after reversing, head down to. So we know that when we're a buyer, we take up the supply zone. When we're a seller, we take it down to that final target. They are our parameters. And then went down to the 1 hour, identified some of that intermediary bullish structure. We have identified points of interest, have alerts set, but then within the impulsive waves of that 1 hour structure, we can look and delve in to the bullishness within each individual impulsive wave. And then within that, analyze it, find trading opportunities. We could do the same again. If I wanted to look inside of this impulsive wave on an even lower time frame, we'd do the same thing. This is an impulsive wave up. The last sell candle would be within this region. So let's say this was our point of interest. You see that price just taps into it we have that wick tap in. If we went down to an even lower time frame, potentially we find a Wyckoff schematic in here, we get involved with, we trade that up. You have to get away from the fact that time frames are all representing a different structure. It is representing that same movement that's happening. The market has one set movement that's happening, but time frames allow us to view that structure more fractally and give ourselves more trading opportunities. And that is quite simply all that time frames are. I hope this has cleared up some things for a lot of people out there who are trying to decide what kind of trade you want to be and how to fit trading around your schedules. If you have any questions about this, anything I maybe didn't cover enough or cover it all, leave it in the comments. I'll get back to you and I'll explain it much more fully. I just tried to pack everything into this video without it dragging on too much. But with that being said, I will see you next week in the next Learn to Trade video.